Welcome back to Asymmetric Edge. If this is your first time here, welcome. Today I'm going to level up your pattern recognition so you can start trading with more conviction. We're going to go over some candlestick patterns and just some basic information about candlesticks that I think you guys will find pretty useful. I'm going to show you the anatomy of a candlestick, 5 bread and butter patterns that consistently flag the shifts in control, and one advanced reversal we use in the room when the market is pressing its luck. I'll also plug in entries, stops, targets, and some risk math, because patterns without execution rules are just pictures. If you want our intraday alerts, scans, and playbooks, the link to join the community will be in the description. The next round of invites will be going out soon, and make sure you get your name on there because after that, I'll be closing it for a period of time so I can get to know all the new members that join. Thanks, now let's get into this video. For those of you that don't know, candlesticks were invented by a rice trader in Japan in the 18th century. They weren't introduced to Western audiences until 1991 by technical analyst Steve Neeson. Candlesticks are useful for recognizing market sentiment and the balance of power between bulls and bears. The key components include the real body, shadows such as wicks, and their color. Understanding bullish and bearish patterns help traders and investors predict short-term price movements. Candlesticks also offer visual and analytical advantages over other chart types. But due to their limitations, they're just one tool. They are best used alongside other technical tools. Like we always say, it takes a lot more than one tool to build a house. All these different things are just one tool inside of your toolbox. Now let's get into a little bit more detail about candlesticks. Candlesticks are the only chart type that bakes in the price and trader emotion into a single bar. Bars and PNF tell you what price did. Candlesticks also hint at who was in control and when they lost it. That edge matters around gaps, earnings, FOMC meetings such as today, and different breakouts. Any place where sentiment can flip fast. There are dozens of named patterns, but you don't need all of them. You need a tight playbook you can run every week. That's what we'll build here tonight. Let's go over a basic anatomy refresher of candlesticks. Every candle has 4 points: open, high, low, and the close. The body is open to the close. The wicks are the extremes. The upper wick, up here above the body of the candle, is where buyers tried and they got rejected. The lower wick, down here below the body, is where sellers tried and got rejected. A full body candle with little to no wicks means one side dominated the entire session. One more quick nuance is strength inside the body. If 70 to 80% of the candle was filled and it closes near the extreme, the momentum is real. If it closes mid-range with long wicks, momentum is suspect. So again, the 4 basic parts of a candle are the high, which is the very highest point that the stock traded that day, the open, which is where the cash open happened, the close, which is where the cash close was, and then the low, which is the lowest point that the stock traded that day. Again, some of this stuff is going to be pretty basic, but I think you'll find it really helpful to just sharpen your tools and really get the basics down, and then you can start learning a lot more advanced techniques and just trade with a lot more conviction. I think it'll really help you out. Here's just a look at the different parts of the candlesticks at different areas on the charts. It's important to just familiarize yourself with these things, and so you can recognize them on all different charts. If we take a closer look, again, we have the open, which is where the open happened, and we have the close down here, which is where the close happened. Now, those are basic, and you don't really need me to go into much more detail than that. But where things get a little more interesting are these wicks. So for instance, over here, we have this top wick on this candle right here. Now, what did we say the top wicks were, or the tops of the candles? These are price rejections. This is where buyers tried and they got rejected. As you can see the next day, the stock sold off pretty hard as these buyers up here were rejected. Over here, we have a bottom wick. What are the bottom wicks again? The bottom wicks are where sellers tried and they got rejected. So basically, you had buyers step in and buy up all of this stuff and take the stock back up. Now we have another one here today. We had the FOMC meeting today, so that kind of messes with things. But it's the same concept. We have a big bottom wick here, which means the stock sold off, but the sellers got rejected because more buyers stepped in and took the stock back up. Now, usually when you get these long bottom wicks, it means buyers are stepping in and they're supporting the stock, so it's probably going to go higher. This stuff might sound basic, but it really works, and it's really simple. A lot of people like to overcomplicate things with trading, and it's really not that complicated. You need to master the basics, though, before you can move on to the more complex things. Before we go over some patterns, I just want to go over some basic framework. One is context. Trade with the trend on your time frame. Dailies for swings, hourlies, 5 minutes, 10 minutes, whatever you use for intradays. Counter trend is allowed only at clear levels, something like a prior supply point, a demand point, VWAP bands, anchored VWAPs, or moving averages. The second thing are triggers. The pattern is the setup. The break of the pattern's key level is the trigger. Enter on that break, not before. The third is risk. Stop goes just beyond the pattern's failure point, usually the opposite side of the signal candle. Size via fixed return risk. 4 is targets. First target at 1R to 1.5R. Second at nearby structures. Prior swings, gap fills, or measured moves. Trail your stops behind swing pivots or 5 to 8 EMA if you're riding a trend. Lock that in. Now let's build a playbook and go over some patterns. All right, let's get into some patterns so that we can actually make money from these things. The first is a bullish bar. All this means is that the open is lower than the close. We look down here, this candle opened down here, closed up here. Bullish bar, stock continues higher. Same thing over here, opens down here, closes up here. The open is lower than the close. Bullish bar, stock continues to push higher. It's pretty simple stuff, but sometimes the easiest money can be made off the simple things. Now, more than just a bullish bar is a bullish engulfing. What it is a green candle that engulfs the prior red candle's body. The wicks don't have to be engulfed. Remember, wicks are just price rejections. A bullish engulfing says sellers were in charge yesterday, but buyers took the wheel today. The trigger is a break above the engulfing candle's high. If we zoom in down here, you can see these two candles right here. Now remember, the wicks don't have to be engulfed. For bullish engulfing, it's more about the bodies of the candle. Here we had a red day. Stock opened up here, closed down here. So sellers were in control today. The next day, we opened up down here. So we actually gapped down from the day before, but buyers were in control all day. The stock pushed way up here and it closed up here. So as you can see, this entire body engulfs this entire body. The green body engulfs and completely covers the red body. This is a bullish engulfing. As you can see, if we zoom back out, the stock here is pushed much higher after this bullish engulfing happened. Now there's some invalidations to these, such as if we lose the engulfing candle's low. So if instead of pushing up here, the stock would have reversed, it would have invalidated this bullish engulfing if the price got below this engulfing candle, so right here. Some use cases for bullish engulfings are pullbacks and uptrends, failed breakdowns at demand, or day 2 continuations after news. Some notes to keep in mind on bullish engulfing patterns: the bigger the body, the better. Volume confirming 1.2x 20 period average is an A+. All that means is more buyers want it in. So it just confirms your bias. So if we were to walk through an actual trade here with this bullish engulfing, our entry would have been at the break of the engulfing high. So the next day, we would have watched this level. It got here, it broke above clearly. So you would have started your trade here. You would have put your stop down here at the bottom of the engulfing body. And your targets, obviously this is all personal preference, but your targets could be something like a 1R at a prior pivot, 2R at a gap fill, or a moving average band. And you can trail your stop on the 5 to 8 EMA. They're pretty simple trades, but they work great. Pro tip: if it forms near a rising anchored VWAP or a daily 20 to 50 SMA cluster, you've got confluence, our favorite. All right, pattern number 2, a bearish engulfing. It's the same idea as the bullish engulfing, but flipped. A red candle engulfs the prior green body, which means buyers lost complete control. We take a look at the chart here, take a look at PayPal. You look where we have highlighted this huge red candle completely engulfed the prior day's green candle. All the buyers from this day lost complete control to the sellers on this day. This is pretty bearish. The trigger here is a break below the engulfing low. So down here would be this engulfing candle's low. You'd set a level right there. And once you get a close below that, you got one right here. It popped back above, tried to get above it, but it failed. It sold down, came back, retested that low, and then you just had a huge sell-off. So right here is at 285. And if you use this bearish engulfing to start your short, or even if you use the low right here on this retest, zoom out, you had a pretty good short here from 285 down to about 67 or so. You're down 76% in less than a year. And all you had to do was use this bearish engulfing. So when people tell you that candlesticks and patterns don't work, don't listen to them. Just like there is invalidations for the bullish engulfing, there's also invalidations for the bearish engulfing. An invalidation for a bearish engulfing would be a break of this engulfing candle's high. So it would be right here. If the chart went up instead and tested this and it broke above and closed above, then it would just completely invalidate this bearish engulfing. Just something to keep in mind. A little tip here on bearish engulfings as well is on earning gap ups. A bearish engulfing within 1 to 3 days is usually distribution. We often pivot to put calendar spreads or debit put spreads then to keep theta on our side. Pattern number 3 is called the hammer. There's a small body on top, the long lower wick. Open, flush, buyers absorb the flush, and we close near the high. It spots seller exhaustion. If you look at the chart over here, we have a hammer highlighted on Dell's daily chart. The trigger is a break of the hammer high. So right here. The next day it gapped up, never even came back, and gave you a chance to retest it. The invalidation is if you break the hammer low. So down all the way down here where the price was rejected originally. If the chart came down, this hammer gets invalidated when you get a close below the bottom of the hammer. But as you can see, these hammers are pretty powerful. Again, it spots seller exhaustion. We zoom in a little bit. Sellers came in this day trying to knock it down, but it got absorbed by the buyers, and the buyers took complete control. We closed near the high of the day. We zoom back out a little bit. Get rid of this for you guys. Zoom back out a little bit. You can see from this hammer, stock's up 35% in about a month. They're pretty powerful stuff. Some context for a hammer. They're usually best after pullbacks and trends, at prior demands, or after gap fills. And as you can see on Dell, this was after a little pullback. We got this nice hammer down here in the chart, marking seller exhaustion. A little risk note on hammers. If the lower wick is massive, consider placing a stop a few ticks below the midpoint of that wick to keep your risk tight, but only if context is strong. Also, if you get an inside day after a hammer, a break of the inside day high is a clean secondary trigger for this hammer to continue working. For pattern number 4, I'm going to go over 2 different doji variants, a dragonfly and a gravestone. We'll start with a gravestone. A gravestone doji is when the open and the close are near to low with a long upper tail. All this means is that buyers ran out of ammo. Take a look at the chart. We have one highlighted here on Unity software. Keep in mind these dojis are signals, not entries. This day on Unity, buyers came in pushing the stock higher, but they ran out of gas and got met with more sellers than buyers. The stock sold off its entire day's gain as it closed lower than where it opened all the way down here. Now it's not perfect, but if you mark this level off, you can see it next couple days it came up, retested it, and it even closed above it. But the next day was a big red bar and it closed below. A close below the gravestone is confirmation. So once you got this retest, buyers tried to push it up above it. It couldn't close above the gravestone's wick, which is a telltale sign that this gravestone is still in control. And this took place around $200 a share on the stock. We zoom out. The stock got absolutely killed from there on. That was the high, all-time high of the stock. It was down 85% in half a year or so. Again, these things are powerful. They're not entry points, but they're signals. They let you know who's in control and what could potentially happen in the future. They tried to get it over the gravestone. They couldn't. The next day, it was met with sellers, and it was just all downhill from there. This would have been a great entry point for a short with your stop loss at this gravestone. The next doji variant I want to go over with you guys is a Dragonfly Doji. It's an open and a close near the top with a long lower tail. The market probed lower, but buyers erased it. Take a look at the chart. We have a more recent Dragonfly here on Netflix. If we zoom in on the Dragonfly right here, this green candle, you can see it's got this really long lower wick, and the open and the close were both near the high of the day. All this means is that sellers try to knock it down during the day, but buyers stepped in and took control. These are usually very bullish and are signs of strength ahead as sellers are exhausted and buyers are stepping in. The trigger on Dragonfly will be the next day that takes out the high. So the high of the Dragonfly is here. You see the next day it came down, tested it. It didn't break the low of the Dragonfly, which would invalidate it. So the Dragonfly is still valid here. Next day, still closed up here near the top of the Dragonfly. And then you can see we've gapped higher and we've been pushing ever since. Now, it's only been a few days after this Dragonfly formed, but I'd like to see this continue to push higher as it really validates this large Dragonfly right here. Also keep in mind to pair the Dragonfly and the Gravestone with location on the chart. A Dragonfly at support is usually pretty strong. A Gravestone at resistance is usually pretty strong. Also keep in mind that volume helps with both of these. Now the next pattern I want to go over with you guys are morning and evening stars. I figured it would be easier to just show you guys a picture of these, as sometimes they're kind of hard to see on the charts. Think of these as reversal structures. The morning star over here is bullish. The evening star here is bearish. A morning star has a long red sell day right here, followed by an indecision candle with a small body and sometimes a doji. The next step is a strong green candle that reclaims into day one's body. This is obviously a picture perfect morning star. They don't always work out this perfectly, but this is just a good example to show you guys. These are really bullish. The trigger on morning stars is when day 3 clears day 1's midpoint, or if it just simply breaks the high. So either halfway through this candle, the morning star is validated, and if it gets over the high of this candle, it's incredibly strong. Invalidation for morning stars is when you lose day 2 low or day 3 mid. So if you were to lose the low of this second day, the small body or the doji, this would invalidate this entire pattern. Also, a midpoint of this candle is also a good spot to mark because if you lose that, the buyers here are starting to lose control. Some use cases for morning stars are on washed out leaders, during sector pullbacks, or during market breadth troughs. Now, an evening star is the same thing as a morning star, just the exact opposite. It's bearish. The mirror image on tops, great at the end of overbought pushes or in the headline pops. Some execution detail. On stars, we often scale half the size on the initial break, half on a throwback retest on day 3's midpoint. And that keeps our entries honest. We're not getting in early, but we're also not chasing. Keep in mind when trading, it's better to be a little bit late and correct than to be early and try and catch an entire move and be wrong. The last pattern I want to go over with you guys is a little more advanced, and it's the island gap reversals. This is one that most retail traders miss, and it's one of our favorites. The definition of an island gap reversal is when a stock gaps away from price, trades for at least 1 to 3 bars, forming an island, then gaps back the other way, stranding those entries. The psychology here is brutal. Participants trapped on an island become forced sellers or buyers. Now you can have a bullish island reversal, such as down here, and you can have bearish island reversals, such as up here. A bullish island is a gap down with a base and then a gap up over the island highs. A bearish island, such as up here, is a gap up, creates the base, and then a gap down below the island lows. A trigger we like to use here is trade through the island gap day in the direction of the reversal. Often you'll get an opening drive. Our stops are on the other side of the gaps. Targets on these are the origin of the first gap, then prior swing. These can trend for days because trapped inventory must exit. A little pro tip here, combine this with open interest walls, dark pool prints, or sector ETF reversing's, and these become A-plus setups. Now those are just a handful of patterns, and if you want me to go more in depth, or if you want to learn more about our favorite patterns in the community, head over to asymmetricedge.org and get your name on the waitlist so you can be on the next round of invites. The link is in the description. Now, the key with all these patterns is turning them into profits. Patterns are not a strategy until you bolt on risk, time, and structure. Risk a fixed $R per trade. We like to use 0.5 to 1R. Hold your rules. If your first target hits quickly, pay yourself and slide the rest of the stops to break even. Let the second piece ride via swing structure or an EMA trail. If there's no trigger, then no trade. If pattern forms into a macro event, such as FOMC or earnings, then the implied move is massive. Consider option structures instead of stock. We scan end of day for these setups across leaders, sector ETFs, and liquid mid caps. Members of the community get the exact screens and tickers every morning and every night. I see a few common mistakes, and I want to go over them real quick with you guys. First is front running the trigger. You're just guessing at that point. Wait for the price to prove it. The second is when you have your stops too wide. Use the pattern's failure point. If that's too wide, then lower your size or just skip the trade. Another is ignoring context. A perfect hammer into a declining 200 day is just a coin flip. Stack confluence. Remember, you don't build a house with one tool. Another common mistake I see is having no exit plan. Pre-write your targets and trailing rules. Trading is a rules-based business. You must be disciplined. If you made it this far in the video, thank you. If this helped you out at all, tap the like button so more traders can find it and get help. Drop your questions below and share which setups you want me to deep dive into next. Engulfings with anchored VWAPs, island reversals on earnings, or intraday hammers at VWAP. If you want these real-time scans, entries, and risk levels, the Asymmetric Edge community link is below. Get your name on the waitlist because once the next round of invites go out, we'll be closing the community for a little bit. We trade these patterns together every day with discipline and receipts. I'll see you guys in the next one.